Stocks aren't too far from the flat line here this morning, shortly after the open. They're coming off, though, record levels for the S&P and the NASDAQ. Now, major indices logging 4 straight months of gains. So far this year, 50% of the S&P 500 gains can be attributed to just a group of stocks, the Mag 7 stocks. That's according to Yahoo Finance's calculation. So where do we go from here? It's a question everyone wants to know. Christian Mueller-Glissmann, he's Goldman Sachs head of asset allocation research, joining us now. Christian, it's good to see you. So certainly we have seen only a handful of stocks really catch much of investors' attention, really be the driving factor that we've seen in the rally over the course of the last several months. That concentration, do you view that as a risk here to the broader market?
I mean, not necessarily, because I think those stocks have done phenomenally well on the fundamentals, and you can justify that outperformance and to some extent the valuations you're trading at right now. What we would also say is that the macro picture is very subtly changing currently, and it has a much more of a reflationary flavor, where it's less about rates relief, where kind of the Magnificent Seven obviously are huge beneficiaries, being longer duration, being more about longer term structural factors. So the market is shifting currently a bit more towards reflation, where actually the economy is doing very well. You start to see green shoots in global manufacturing. Yes, there's a downside. The inflation is also a bit stickier. The inflation momentum is less negative, but it could mean that the leadership within equities is broadening out a bit, where you can have like economically sensitive areas within equities maybe benefit.
Which areas do you see a reinflation trade most concentrated, and are there specific companies that are the biggest winners in that instance?
Yeah, it's as always not so easy because first of all, cyclicals have not really suffered as much as they would have normally if you have a big global manufacturing slowdown like we had in the last year. A lot of them have actually maintained margins, maintained profits, but they've run down inventories. So we're going through a restocking cycle, and we need to understand where the pricing power will be and where the companies can actually benefit from the pickup in manufacturing. We've been leaning in our research a bit more towards consumer cyclicals, because we see a lot of strength there, real income growth supporting consumers. There's selective industrial areas like business services, for example, has been an area we've liked in Europe. So I think, it's still requiring a bit of a selective approach. The last thing I would say is small and mid caps have been a big kind of favorite area to kind of position for a bit more reflation, because these type of areas tend to be more economically sensitive, and they have suffered a lot. They're quite cheap right now. So that would be areas where you can look for. But we need to to be completely fair, we need to kind of see a bit of earnings news as well from those, because so far it's pretty early, those green shoots.
Christian, in your latest note, one of the charts that caught my attention, we've been talking a lot about some of the excitement that we've been seeing playing out within crypto, specifically Bitcoin. And you were tracking Bitcoin's performance, saying that it has now appeared to have reconnected to risk appetite. I'm curious what that signals to you, and whether or not this is some momentum here that you think is around to stay when it comes to the excitement surrounding crypto.
Yeah, I mean, as you know, Bitcoin is a quite interesting asset. First of all, it has elements of a real asset. It has elements of a commodity. There's some elements of FX. So from that perspective, we're still learning kind of what are the drivers of Bitcoin. And I think if we look at the historical correlations with different assets, we know it's been very linked to the dollar. So weaker dollar has historically been good for Bitcoin, but it's also been very linked to NASDAQ performance, and it's been very linked to equity performance. And if you see risk appetite pick up, and that obviously comes alongside often equities doing well, and the NASDAQ often being in the driving seat, I think that supports Bitcoin. But I think if we look at the recent shift, I would definitely say it's consistent with a broader increase in risk appetite, which reflects slightly better macro conditions, and also with the reset in volatility, which kind of drives a bit more risk appetite. So you can see that as you like. On the one hand, it's another signal that we're probably dealing with a relatively strong macro backdrop that supports risk appetite, which spills over to Bitcoin. You could argue Bitcoin had an incremental support by the launch of the ETF, which puts focus on it, which generates momentum. But you could also see it as a slightly concerning signal that maybe there's a bit too much optimism building at this point. I'm probably less worried about that, but I would still say, looking at this chart, you could be worried about that.
Is there a difference between risk appetite and FOMO, Christian, from your perspective? I mean, it seems like, especially with now a lot of focus on the Ether ETF, that Novogratz is believing that is going to come forward before the end of this year for sure. You know, now all of these things considered, there is more fodder for some of the FOMO trade to continue to persist here.
I think, risk appetite in most cases tends to be driven by fundamentals. And we've done a lot of work on that, benchmarking our risk appetite indicator to macro data, to different type of combinations of growth, inflation, different drivers of growth. And I would say that what we're dealing with right now is at least in part, if not to a large part, linked to macro fundamentals, which have been pretty strong coming into the year with a bit of a Goldilocks backdrop behind us. And now it's shifted a bit towards reflation. And obviously there is an element of FOMO usually at the end, where I think if risk appetite picks up, if assets perform very strongly, you kind of get some type of final capitulation of the last investors that are really following risk assets and riskier assets. But to be honest, we're not seeing that right now. If you look at fund flows, for example, year to date, there's actually been 200 billion of inflows into money market funds. If you look at the inflows into equities, it's been more like 20 billion. If you look in general at the flow picture, it doesn't show like this extreme bullish sentiment that would tell you that we're in a kind of strong FOMO environment. We see certain indicators quite stretched, futures positioning, some of the sentiment surveys. Options skew, kind of the cost of puts versus calls is very low. So there's some areas that arguably are stretched, but you don't have the breadth. You don't have the breadth that normally indicates that things have gone too far and it's pure FOMO driving the market.
All right, a lot of investors trying to distill that down and really make a sound investment decision as well. Christian Mueller-Glissmann, who is the Goldman Sachs head of asset allocation research. Thanks so much for taking the time here today.
Thanks.